The market had a quite nice start to the month of October, and there was certainly reason to understand or to believe that things might be getting bullish and that it might be time to bottom feed and start buying stocks for the long haul. That might be the case. You might be able to buy stocks here and do well over the long haul. However, we're trying to act with a higher degree of precision than that. And it's been yielding us great results recently, acting with a high degree of precision. And we think that while we have fallen a lot, that is true, there's still more to go. However, we're closer to the bottom than we are to the top. Now, what does this mean? Why do we believe this? And when will we know the bottom is in? Well, that last part's going to be hard to say. I have correctly called a bottom on this channel. That is the March 2020 bottom. When we said on March 19th, we thought we were at a bottom. The actual bottom was March 23rd. So we're going to use that and the logic and the principles that we used then to address when we're going to get a bottom here, but we're not going to get into that yet. We're going to talk about why there's more to go and why we're not yet calling for a bottom. We don't want to call a bottom yet, as we didn't on March 15th, for example. Why are we not at a bottom? Stocks are down so big, we're kind of fluttering around here. Today is not showing any signs of true despair. The reasons why we think there's still more to go center around this disconnect between the doves and the bulls, expecting that the Fed is going to change. There's plenty of this sentiment out there. There's at least this thought of this sentiment, and the reality, which is that's just not going to occur. It's just not going to occur. The Fed has continued to say, and they're going to continue to say it's not going to occur. They're going to say that they have been saying, and they're going to continue to say that they're okay with unemployment going up, that they're okay with pain to the economy occurring. The psyche of the market is that things happen and then they reverse and there's a massive rally. That is not going to be the case here as far as I'm concerned. I think it's going to be a slower process here. And let's not forget, leading up until the first trading session of this year, which is interesting nonetheless, we were in what was called the Goldilocks environment for stocks. Goldilocks. Interest rates were low. Stocks were just going up, going up, going up, going up, going up. And then all of a sudden, people started to realize interest rates, or the stock market was going up. Interest rates were going up. And some weird things started happening. Oil prices started going up. Inflation started going up. And all of a sudden, we weren't in the Goldilocks environment. Now, a big part of that Goldilocks environment was the Fed. The Fed was accommodative. They were kind of underpinning the whole thing. Now we've got a hawkish Fed that is continuing to surprise the market with its hawkishness, isn't going to abate. I mean, I cannot stress enough. They're not going to. I just heard Scott Minerd say that they were going to stop hiking in November. No, they said today. Evans, I believe, 125 basis points rest of the year. This just has to be penned in. But Scott Minerd called for a 20% correction in the market, and he is saying this. I think he also thinks more downside to the market is possible. But there are people who think the Fed might turn and the market might rally. That's a thing. And that adjustment has to occur. Those people need to be faced with reality and adjust for reality, or not, I don't know, but for the market to truly bottom. Additionally, we're just talking about the Fed. The Fed is vaguely mentioning some signs of economic weakness. But the market seems to only be pricing relative to interest rates. I mean, we're not at historically attractive multiples or anything. Interest rates, I mean, you can't go all the way back in history because the economy was less correct. It was harder to value who could pay debt, all these kinds of things back in the day. So maybe interest rate risk has been reduced a little bit for the lender. But 4%, it's starting to get attractive. So it's certainly going to take away from the people who buy stocks. And we're not getting to 4% and coming right back down with the Fed being easy. We're getting to 4% and we're going to hold 4%. And even when we come down, we're not going to come back down to 0%. We're going to maybe come back down to like 3%. Think about that. That's kind of what goes on when the economy is doing okay and things are fine. If there's a total recession, crazy situation, yeah, the Fed might drop rates that low. But they, I think, learn to be a little bit more hesitant around that. Additionally, I heard some Fed member today, I think it was also Evans. I don't know the full picture of this, but if this is the case, it's quite interesting. Say that they expect the Federal Reserve to completely reduce its balance sheet over the course of 3 years. I don't know if that means the COVID additions to the balance sheet or the entire balance sheet. If it means the entire balance sheet, I mean, there's just more tightening to go. Like, that's just the way it's going to be. The Fed is going to be in selling assets into the market, shrinking the money supply. This is the new paradigm. We have to prepare for it. The Fed wants to defend the dollar. That's their goal. That's their job. And this is the paradigm. I mean, we were in Goldilocks, ultra stimulative. They're admitting fault that they tightened too late. And they're going clean house. They're still in the early days of it, as they said today. They're still in the early days of it, okay? You want to fight the Fed? You want to wait that out? Be my guest. I'm getting nervous. I'm even selling some energy options here and there, raising some cash. And we'll see what happens. You know, I just see AMD warns third quarter revenue shortfall. We didn't even get to the economy, okay? Economy seems to be weakening. Interest rates are going up. That's what they're supposed to do. They're supposed to decrease demand, as the Fed has said it wants to do. So economy is weakening. Now, when do we find the bottom? On March 19th, we got jobs data that was poor, very poor. I believe it was some 500,000 jobs lost. It was the first real COVID jobs report. Let's not forget New York City, etc. went full lockdown mode March 13th. March 12th was like the last day to go to restaurants, whatnot. March 13th was the freeze. March 19th, we got the jobs data, and the market was up like 0.5%. Like, it was basically flat, nothing big happening. Especially because you have to realize we were having circuit breaker days. There were like down 10% in a single day during this period of time. This was insane move, like price action that was just happening. It was just an insane period of time for the stock market. So to see the stock market up just a touch, nothing crazy going on. But we got the data we needed. At the time, it was, or what path are we going to take? Oh, we got huge job losses, bad economic data, and the market was basically flat. You can go back to the March 19th video, March 19, 2020, and we discussed it here on this channel. And I just decided, we've had tremendous decline. We got bad data that confirmed our fears, and the market's barely moving. That's an indication for a bottom. So, we still have more data to come. It's going to get worse before it gets better. Interest rates are going to go higher before they go lower. And we're going to have to get to a point where we're getting the economic data, because that's kind of the next wave I'm fearing is stuff that just comes out of AMD. I mean, I think it's just going to start becoming one after the other. It's going to be a little bit of a snowball, as the Fed is hoping it is. One after the other, companies reporting or guiding negatively for economic forecasts. Once we start getting that kind of stuff and the market is flat, not really reacting to it anymore, that's when the market can bottom. Not when we foresee negative economic data still coming in addition to rate hikes and in addition to a hawkish Fed. They're not even seeing what they intend to see. They're still remaining hawkish. So we have to remain somewhat sidelined. We have to remain in stories that can fundamentally be strong. I mean, energy, yes, we still have, but we're starting to trim gains just because we have tremendous gains. We're like aggressively overweight, like roughly 30% of our portfolios in energy. But, we're trimming gains today. That's what today was about, trimming gains. So We'll see. I don't think the bottom's in. I think we've suffered a lot, but I don't think the bottom is in yet. I think there's still more to go. When it will occur, maybe we're going to have another leg now. Maybe we're going to chop around in here till the next Fed meeting in November. But we will see what happens. That's today's video. Until next time, peace out. Also, last thing, I've been banned on Twitter. So I want people, always tell people, please follow me on Twitter because I post a lot on there. You can follow me on the Leftskewed Twitter, and we will keep in touch. Thank you for watching today's video. Until next time, peace out.